financial argument. Follow us on YouTube.
We have a returning guest, Mike Maloney. Mike has one of the world's most highly regarded investment education companies since 2005. He is the author of the best-selling precious metals investment book of all time, Guide to Investing in Gold and Silver. He is the creator of the video series Hidden Secrets of Money, USA's Day of Reckoning, Hidden Secrets of Money 7. He is the founder and owner of goldsilver.com.
Thanks for having me.
Thanks for being back here. I really appreciate it. And I wanted to get your take on how the economy is doing right now, because the Atlanta Fed came out with their estimates, and they estimate the GDP, and they're saying now it's down to 0.5%. And we're seeing retail stores starting to close a lot more than anyone really thought were going to close. What's your take, and from your research, how is the economy doing since Trump became president? Has it gotten better? Has it gotten worse? Where are we right now?
Well, what we see is the same divergence that we've seen since the crash of 2008, where it has gotten better for Wall Street, but everywhere else in the economy, it's really not better. It's getting worse. And, I just think that it is getting comical at this point. People have already been through the crash of the NASDAQ in 2000 and then the real estate bubble popping in 2007 and 8. They've been through that. They know what it's like, and they can't recognize the signs that we are at a top again. I mean, all of the indicators are just screaming at us that this is the time to be getting, back in November, I said that there would be a love affair with the new administration and that the stocks would probably rally until about May. And then be a 6-month love affair, and that the markets would then most likely roll over and we'd see a top put in. And now we have the debt ceiling debacle coming up again. They haven't really been talking about it yet, but they aren't out of cash yet. They're able to do some juggling right now. So they keep this appearance that everything is going on just peachy. Yet, on Main Street, it isn't going along that great. Things are getting worse. Things are deteriorating, and we're going to see, I think that this next crash, 2008, my producer, Dan Rubach, once said it was a speed bump on the way to the main event, and I sort of hijacked that term. It was just a speed bump on the way to the main event. We're going to see, in 2000, we had a stock market crash. In 2007, we had a stock market and real estate crash. This time, we're going to have a stock market, real estate, and bond crash, a crisis. And it's going to be horrific. And so that's my short answer.
With all this going on right now, we see gold, silver, precious metals, they've been creeping up a little bit. And just in the last couple of days, I think it was 3 days in a row, where there were thousands of contracts thrown at gold. But gold really didn't budge this time. Any explanation on why it wasn't brought down as it usually has been brought down before?
Well, it's noodling around in a sort of a sideways range, and so is silver right now. And I'd like to see them pick a direction. They've been recovering for a few months, but they haven't exceeded their 2016 highs. They're only about a little more than halfway up from where they were when they peaked in 2016. But I've been following the Commitment of Traders reports, which is the analysis of the largest traders in futures contracts on the commodities exchange. And it's broken down into 3 categories. The commercials, which are large bullion banks and large hedgers, people that produce precious metals and people that refine precious metals and so on, and the biggest dealers of precious metals that have their inventory hedged. And then there's the speculative funds, and then there's the non-reportables, which are small traders, just people, individual traders playing the futures market. And what you see throughout time is that if you take each category, especially the commercials, and they will have both long and short contracts. So they're betting both that gold and silver are going to go up, and they're betting that it's going to go down. And there's reasons for that. When they are sitting on inventory, they will sell a contract to offset any price fluctuations. So they've got, 100,000 ounces long that they own, and to neutralize a price fluctuation, you will sell $100,000 worth of contracts, so you're short on the contracts. And then the price, if you're buying metals at one price and you're going to make a 25 basis point profit or a 50 basis point profit, they can drop by 50%, the metals that you're sitting on, and the futures contracts go up and offset any price fluctuation, and you can sell it and you can make your profit regardless of which direction the price goes. And so that's one of the reasons for the position of the commercials. But what you see is that when the commercials are on one side of the bet, when you deduct their longs from their shorts, you'll see a net position. There will be a bunch of short contracts left over that the speculative funds then hold the opposite trade on. And when the commercials build up to a very large position, it usually means that there's a net position where they're very short. It usually means that there's going to be a price drop coming up in the future. And right now, on silver especially, we have the largest net short position in history right now. And, I'm a precious metals investor. I've been investing since 2002, and I accumulate every single month. And so, I started buying gold when it was $325 spot, and silver at about $4.30. And I've been dollar cost averaging in ever since. I know that there's a big crisis out there, that the two crises that we've already seen in this century, each one is getting bigger, and there's a third one coming, and it's simply because of the overwhelming amount of manipulation that governments around the world have done. I mean, right now, the ECB is still doing stimulus, and so when you look at what the world's central banks are doing, this all is a manipulation, and manipulations always fail. And what they do is they warp the economy, and it builds up pressures, and when that's released, it's a lot worse. And so the price, I'm hoping that silver drops a bit and gold, because I want to accumulate more at really good prices. What I see out there, though, right now is that the public is not, the public does the opposite. They usually buy things that are high and sell them when they're low. They're expecting instant performance, and you need to accumulate when it's low, so especially now, so that you're protected from all of the stuff that's coming down the road at us. And I think the stuff that's coming down the road at us is huge, and it's something where there's going to be an enormous wealth transfer, and the people with the precious metals are going to be the biggest winners.
Now, you mentioned that people usually purchase high, but we see Russia and China, they're accumulating a lot of gold right now.
Well, between Russia, China, and India, they're accumulating, they average about, the amount that they accumulate each month averages about the entire production of the world. Sometimes it far exceeds it. And whenever it exceeds it, that means that it has to come from the West. Yes, they are being very, very smart. They have just done steady accumulation for a long, long time now. They know that something is up. They know that we're nearing the end of a global monetary system. There have been several, when I was writing my book, I discovered that every 30 to 40 years there had been a new monetary system. Classical gold standard before World War I, the gold exchange standard between the wars, the Bretton Woods system from 44 to 1971, and now we're on the US dollar standard. And this is the oldest of it's the longest lived of all of the global monetary systems, and it's the poorest. The design of it is a very unstable design. If you were going to sit down and design something from scratch, this would not be it unless you wanted an advantage. And we gained a big advantage over the rest of the world, but that ends up having to be paid for sometime or another. China, Russia, they are buying, their central banks are buying precious metals in enormous quantities because they know that the game of musical chairs is going to end soon, and that there's not very many seats left. So they're taking theirs while the music is still playing.
So with the Fed right now raising interest rates, because we know back in 2015 in December, they raised interest rates. And in December of 2016, right after the elections, they raised interest rates. And then when Trump was inaugurated, they raised interest rates. And now I think I heard there was about a 69% chance that they're going to raise interest rates once again during this debt ceiling debacle. What effect does that have on precious metals?
Well, looking at it from the standpoint of the economy in general, they're going to, they haven't allowed the free market to work for a very, very long. We haven't really had a free market ever since Federal Reserve was established in 1913. But they have gone more and more and more toward manipulation and holding interest rates down. When you look at what's happening around the world, I mean, there's still a lot of the world, a lot of the countries that are responsible for the majority of the GDP in this on this planet, a lot of them are still in negative territory. Yeah, we're raising it, but we're raising it at the end of a cycle. If you take a look at the length of recessions in the United States, I believe there have been 47 economic expansions and recessions since the United States was formed. And we are now in the third longest economic expansion in history, right now. And next February or March, it will become the second longest economic expansion in history. Well, that means that the odds of this going on for another year are almost, the odds are starting to approach a 0% chance. I mean, there's probably over a 90% chance that there will be a recession starting this year. And if it doesn't, then those odds go up, that there would be a 92, 94, 95% chance that within 2018 there will be a recession. And by allowing, as they raise interest rates, one thing that's interesting right now, I'm looking at a chart of the dynamic yield curve. And just before each of the previous market crashes, you see the yield curve start to flatten, which means that normally investors want a higher percentage return for loaning when you buy a bond, you're loaning currency to the government. And if you're going to loan it for 30 years, they want a pretty good percentage rate. If you're going to loan it for 10 years, they don't charge quite as much for loaning currency for 10 years. If you're going to loan it for 3 months, they charge a much, much lower rate. That rate sort of floats with the condition of the economy. However, those are the rates, those short-term rates that the Federal Reserve has pegged, and they've pegged it artificially low. So the yield curve, you couldn't see this warning sign of short-term rates going higher than long-term rates. Can you imagine investors charging more to loan the government currency for 3 months than they charge for loaning it for 30 years? Well, that actually happened just before each of the last two market tops. And what we're seeing right now is a yield curve flattening from from 5 years out to 30 years. And as the Fed raises interest rates, they're raising the interest rate on that short-term money. And when they do that, it allows this. I'm glad they're doing it simply because an indicator that I watch could potentially start working again because it's been broken ever since they started manipulating the economy with these low interest rates. But the thing is, we are so long into this economic expansion And now they finally decide to raise, and this is the weakest economic expansion in U.S. history. It's the performance, the growth year over year of the GDP has been the worst in any economic expansion in U.S. history, and they bought this expansion with $3.4 trillion of brand new currency, roughly. We're up at we hit $4.2 or $4.4 trillion from just 0.8 at the before the market crash in 2008. And so this is a bought and paid for economic expansion, manipulated all the way, and they're ending all of this stimulus and assistance. They're taking off the training wheels at the very end of the economic expansion, just when another recession is overdue.
Do you think they're doing it on purpose, where they're raising the interest rates? Because if you go back to 2006, 2007, they started to raise the interest rates very, very slowly during that period. And then, of course, people couldn't pay their adjustable rate mortgages and people left their homes and things started to really fall apart. And then they started lowering it. Do you think they're doing the same thing because they realize that they really can't raise the rates, but they're starting the collapse of the system now by doing this and then saying, okay, we have to go and lower the rates and maybe even go negative. And that gives them the excuse to go negative and actually create more currency.
Well, at the very beginning of '06, that's when this yield curve went flat. The treasuries were, the 3-month was at 4.65%, and so was the 30-year. And then it inverted just before the peak, and then the crash, and Ben Bernanke took the 3-month down to pretty much zero, somewhere between 0.25 and 0.5. And yes, they're raising this at exactly the wrong time, but it'll allow this indicator to work. But it's the same thing that happened just before the crash in 2000, and it's the same thing that happened just before the crash in 2006 and 7 is when the yield curve looked like this. So I don't know if they're doing it on purpose. I doubt it. I think they're just these people are very divorced from reality, is what I think. They live with these mathematic models and equations, and that's what's in their head. They're not looking at human action. They're not looking at the psychology of the economy and the psychology of the markets, because that is actually more important than their mathematical equations.
Now there are many people out there who thought, I was one of them, who thought the economy was going to come down much, much sooner than this. And here we are today because the central banks around the world, they continually to manipulate and they continually print money. And, this hasn't really ended as of yet. Does the Fed, are they running out of ammunition at this point? Can they just continually create currency? Can we just add more debt and everything will just be fine?
No, they can't do it forever. Something comes back to bite you in the ass later, and boy, we're going to get bit hard this time. The manipulation that works in the short term, but you end up having to pay for it in the long term. And like I said, this economic expansion was bought and paid for, and what we got was a really crappy economic expansion. I want my money back. The economic expansion they bought was not, we should have gotten something better than average if they print all this currency and buy an economic expansion, and we got the worst performance in history. This is going to end badly. And what I'm amazed at right now is that what we're seeing is the East is still is increasing their buying of precious metals, and the West, especially the small investor, the person that needs to be protected the most, they are losing interest and starting to chase the markets at the exact wrong time.
Yeah, classic bubble type of scenario, because what I've been seeing is that insiders, they're getting out of the market, getting out of real estate, and there's a lot of speculators, retail investors, all piling in right now, and this is not a very good sign at all.
No, and a whole bunch of the other market internals have deteriorated. There are just warning signs everywhere, and they're the same warning signs that happened in 1999 and in 2007, and people just aren't paying attention. We are putting in another peak. I mean, this could go on potentially another year, but I really think that this summer, that sell in May and go away saying does hold true. If you analyze many, many years and you take the performance of the markets from May through October and then November through April, what you'll see is the November through April is responsible for all the gains. And May through October, if you had invested back in the early 60s and you were in the markets long, betting that they're going up, the general equities, the S&P 5,000, actually gave a negative return from 1960 through today. And so I have a feeling that, the debt ceiling debacle, these debates will come back again in May. And that is the point where things will start to unravel if they don't have some sort of plan in place where it gets raised without any big fight or discussion. If there's a fight or a discussion or a government shutdown, that will cause the peak of the markets. And then the rest of the year, later in the year, we'll probably see a big rollover. And when this crash happens, it's going to be worse than the last two combined.
Now, last time you were on, you spoke about deflation and inflation. And for some, people are saying that we've been seeing deflation. And for others, they're seeing inflation with food and other costs like health insurance and housing and things like that. Where are we right now? Are we deflating or are we inflating?
Yeah, when I wrote my book, I discussed this phenomenon of some things inflating and other things deflating, and I called it indeflation. And that is the period that we've been in. If you take a look at across all commodities, we've been in a big deflation since the crash of '08. And but then you look at asset classes like real estate and the stock markets and bonds, and you see a huge inflation in these areas. And so it's this skewed, warped economy. And the more warped it gets, the worse the correction is when the market overwhelms the manipulation that the government and the Federal Reserve have caused. It's going to be something really bad. But I predicted deflation before big inflation or hyperinflation. I call it the roller coaster crash, and I really do think that we are absolutely on this course that I predicted back in 2005, 6, and 7 when I was writing my book. It is playing out almost exactly as I wrote it. And so when the Federal Reserve started creating tons of currency in 2009, 10, and 11, 12, 13, 14, when they started doing all the quantitative easings and the bailouts of late 2008, a lot of newsletter writers and economists, actually the vast majority, were screaming hyperinflation. I was about the only, there were a couple out there that were saying, no, deflation. It's got to be deflation. And what the Fed can't control is people's, their emotional state. They can't control the fear and greed of the public. And when the public is fearful, velocity of currency slows. That's what they can't control. They can control, the prices are determined by the quantity of currency in the system times the velocity of the currency. The velocity is how many times a unit of currency is involved in a transaction over a period of a year. And what happened when they created all that currency is velocity fell to exactly offset it. You can create a bunch of currency, but you can't necessarily get the public to go out and spend it.
So are we going to see inflation creep up on us, or are we going to wake up one day and have this hit us right in the face where we go out to the store and all of a sudden everything is just increasing in price dramatically and we can't even keep up with it?
I think it's going to be both. It's the roller coaster crash. First, when this next recession comes, which has to happen, there have always been recessions. And we're now in the third longest in history. In less than a year, it's going to be the second longest in history. So the odds are that it's going to happen soon. When this happens, the markets will fall. There will be some sort of crises. We don't have all the subprime stuff out there this time in real estate, but we've got subprime auto loans. We've got a whole bunch of we've got problems in the bond sectors. We've got problems with demographics where the aging baby boomers are overwhelming all of the pension plans and Social Security and everything else. All of these things will become exposed, and the governments around the world are going to start printing in unison, and they're going to print and print and print, and velocity will just slow and slow and slow, because this time, if people watch Hidden Secrets of Money 6 and 7, they will see all of the reasons that this is what has to happen, and it really does have to happen. We can't go directly into inflation without a deflation happening first. And part of the reason for that is this huge bump in the population, the baby boomers. 75 million people, about a quarter of the U.S. population, are all going to be retiring soon. And when they retire, they have to sell assets, and that causes the stock markets to go down. It causes real estate to go down. They're now empty nesters. They don't need a 4-bedroom house anymore. So all of these assets go on the market. When there's more sellers than buyers, that causes prices to fall, and so you have deflation. And then as the baby boomers see their 401ks and their IRAs start to fall, when the value of them starts to drop again for the third time this century, when they see it's taking a plunge. They got punished pretty bad in the NASDAQ crash of 2000. They got punished really bad in the real estate and stock market crash of 2008. They're going to get punished even worse this time, and what's going to happen is they're going to say, I'm through with the stock market. I'm through with speculation. I'm just going to save. And when you save, the velocity of currency the currency that you put in your bank account or your piggy bank, that doesn't circulate. Its velocity is zero. And so you take a certain percentage of the economy. If you get these 75 million baby boomers getting really worried, they have to be happy and feel like they can go out and spend. When they can go out and take their friends out to dinner and everything, then the economy works. But right now, we have such a fragile, debt-ridden economy that this next time that they get scared, velocity is going to slow. And what's going to happen is they're not going to stop saving until they feel like they're comfortable enough to where they, it'll be different for all the different economic classes. For some people, they'll decide to go out and, somebody that's been fairly poor, if they get $100,000, they'll feel comfortable enough to, after 5 years of saving or 10 years of saving, go out and buy a big TV or a brand new cell phone or a new computer or a new car. Most people, they're going to have $1 million or more. And then, for somebody that was upper middle class or well-to-do, they're going to have $10 million or something like that before they feel comfortable enough to go out and start spending it. And once they start spending, so during that period of time, governments around the world are going to print and print and print, and they're just going to keep on printing until deflation does give way. And when it does, there will be so much currency in the system that there can be a hyperinflation even if they turn their printing presses off.
Now, I wanted to throw something else into the mix here, since you've been talking about all this, because we see things geopolitically happening around the world, and we see there's an instance with North Korea, there's an instance with Syria, and it looks like it could be that war is on the horizon. How will this affect the economy, precious metals? Is war actually good? I mean, if you listen to the corporate media and others, they tell you that, war is going to be good for the economy, more jobs, more people making things, but of course people die in wars. But how is this going to affect the economy, precious metals, and everything else?
First, anybody that says that war is good for the economy is very misinformed. they're getting that false impression because of what happened during the last two world wars, where we weren't in the wars for at least in World War One, we were only fighting for about 6 months at the end of World War One. So during the time that all of Europe went into war, they took all their young men off the farms and turned them into soldiers. They had to import all their grains from the United States and the materials to make weapons. We were not supposed to be selling them weapons, but we did sell them some weapons. And so when they do that, there were tremendous gold inflows, and the gold stocks in the United States, the stocks that back the U.S. dollar, those went up 70% during World War I. And then we had the Roaring Twenties, and it was because they were busy. If you look at what happened in Europe, all the combatants, their economies were hugely damaged. And so Americans are the only ones that have this fallacious belief that war is good for the economy. When World War II happened, Hitler started, saber rattling in 36 and 37, and 38 annexed Austria, and 39 invaded Poland. And Pearl Harbor happened in December of 41. And it wasn't until like August of 42. So you've got from 38 to 42 before we got in the war. And what you saw then was our gold stocks went up another 117% on top of what had happened during World War I. And so this belief that war is good for the economy, yes, it's good for the economy if you're not in it and you're selling them the tools of the trade. But this time, we're the ones that are initiating wars. We're the antagonists here very often. And if we are in the war from the beginning, we're going to learn the same lessons that Russia and all of Europe learned during World War I and World War II. War is devastating for an economy, and it will make the U.S. permanently poor. We will never, if something like this does happen, and right now, I see geopolitical risks that I've never seen before. And, I grew up during the Cold War. I grew up when they would tell us to duck and cover under our desks. So, as the comedian Lewis Black put it, they were telling us to hide under kindling from a nuclear fireball. The amount of geopolitical risk and the unstable economy. Now, one thing that does happen quite often is when they need a distraction. War is a good distraction. If the economy turns sour, getting into a war is a way to keep people from blaming the powers that be on the economy. And so, this may be something that happens. I don't know. It's just that I've never, I grew up during the Cold War, and I've never seen geopolitical risk like we have today.
Mike, thank you very much for being on the X22 Report Spotlight. I really appreciate it. Once again, how can people see your work?
It's a lot of it is published on goldsilver.com. There's the Hidden Secrets of Money. You can Google Hidden Secrets of Money. You can Google Mike Maloney. You could go to goldsilver.com, and please watch episodes 6 and 7. Episodes 4, 6, and 7. Episode 4 shows how the global economy works, how currency is created, and most people don't really understand it. It's a purposely complex, obfuscated mechanism that basically cheats you and robs you of your wealth. We're all living inside this giant pyramid scheme. It's like the movie The Matrix, and watching episode 4 is sort of like taking the red pill.
Mike, once again, thank you very much for being on the X22 Report Spotlight. I'll take those links. I'll put them at the bottom of the video. So all you have to do is click on the links. It'll bring you right to those videos. Also, there's a discount code for bullion. If you go to goldsilver.com and you use X22 Report, Mike is going to give you a discount on gold and silver. And I really appreciate you being on.